That is highly likely. I remember when starting this, we were actually recording very high sales. And would realize that according to the book, just by the face of it, we were making money because we could be selling about maybe a ton in a day in the beginning. But we realized we were ending up ignoring the very small expenses that we thought maybe they are very insignificant. We have transaction charges, those kind of things. You tend to ignore those very small expenses. But at the end of the day, when you put all of them together and get a total, you realize there's quite a lot that you're not capturing in terms of expenses that are also eating into your profits. So once you really get some kind of a professional to do the accounting for you, or indeed get a software where you could be recording the sales, at the end of the day, we realized that actually we weren't making what we thought we were making, and that was terrible.
Uh, this is surprisingly common and incredibly dangerous. Your end of day reconciliations show that you hit high sales records, but your profit and loss statements show negatives. Esther, what are some of the things that could lead to this?
I think this is a clear case of thinking that you're winning, yet you're losing. I'm glad that Wahome realized quite early and rectified this in his business. So this scenario can be brought about by three things. One of them is the liquidity gap. When you make a lot of sales on credit, while having debt is an asset, it ties up actual cash that you need to be able to finance other business expenses. And so you might be having a lot of money coming in, but you don't have liquidity as a business person to pay business expenses. The second thing is that as a business person, you need to be able to differentiate between revenue and profit. So revenue is all the money that comes into your business, while profit is what you remain with after paying your expenses. So whatever cost you have incurred to make the sales reduces the revenue that comes to your business. And it's very important to be able to differentiate the two. The last cause of this is that in business, we have sometimes a very high cost of customer acquisition. Let me give you a case scenario. If the cost of acquiring a customer is 400 shillings to make an Instagram ad, but on the other hand, when this customer comes to your business, you sell them a product worth 500 shillings. Yes, you've made a sale and received 500 shillings, but you spent 400 shillings to make that sale. On top of this 100 shillings is also supposed to cater to other business expenses. You realize that the more ads you put out on Instagram, the higher the cost of doing business. So regardless of how many sales you make, the business is actually not making a profit.
I can actually see that happening. They seem like complex scenarios, but they are more common than one would think. Is this an experience you can relate with? Tell us in the comments.